let's talk to Mark Chandler. He is an independent financial expert from Harrogate. Mark, thank you so much for being on the show. So banks, building societies, withdrawing mortgages. How big a deal is this, Mark?
Well, a very good afternoon to you. Of course, the mortgage is really the symptom of what's been happening for the last couple of years. If we think about the COVID situation, and then we had quantitative easing to try and prop up the economy, we've had the furlough scheme to prop up employment for employees. This has led to a big build-up of inflation. Now, on top of that, we've had the war in Ukraine with Putin. So we've had supply chains cut off. We've had price increases on goods, shipping cost increases. So the whole economical situation in the world has really worsened over the last couple of years. The inflation we have in the UK is purported to be 9.9%. Arguably, it's much higher than that. If you go into the supermarkets, if you're looking at a 10% increase on your bill, you'd be lucky. It's much more than that. So something had to be done. Now, the mini-budget's been criticised, but as of yet, we don't really know how it's going to pan out. We know there's been some tax cuts, and we know that they'll be very welcome by some people. But the rest of the market is thinking, well, how is the UK government going to pay this back? What is it going to look like? And that's what's led to the concern over our currency and then the drop in the value of the pound. So it is worrying. From my point of view as an investment advisor, we're seeing funds dropping dramatically. So this will be for people saving in products to buy their first home, right through to people about to retire with their pot of their pension pots. So they'll see those decline dramatically, and it will at least be volatile for some time to come. So it is a time of great concern.
How rare is it, though, for banks and building societies to withdraw mortgages? Or is it something they're doing all the time, we're just not aware of it?
Yeah. So from time to time, they will drop. They will come out of markets. That's not unusual if they have their fill of a certain product they're offering. So there may be a fixed rate. But where banks are withdrawing because of market or economic forces, slightly more unusual. But there's a couple of things to consider there. The banks do have a duty of care to make sure that people can afford to pay these mortgages. They have to build in elements of price increases. Now, at the moment, there's massive uncertainty over where interest rates are going to go. Ensuring affordability is very, very important, but also, of course, they need to make a margin themselves. So with interest rates, we're not really sure where they're going. It's difficult for them to pitch the rates correctly to the consumer.
From what you do know, Mark, then, what can we expect to see with mortgages over the next coming weeks, months? I mean, there'll be people thinking, how much more am I going to have to pay with these rising interest rates?
Yeah, so there's a few aspects to this market. There are people that are about to buy houses. There'll be people for the first time or multiple times. There'll be people looking to remortgage on existing deals. And then, of course, you also have the equity release market, which is a growing market. This is where people are using their houses as ways of funding their retirement when they are cash-strapped. Now, we're seeing these rates increase by the day. So I think that interest rates, the current base rate's around about 2.25%, I believe. And what we will see is over the coming weeks and months, we will definitely see the rates go up. And, of course, the Bank of England Monetary Committee will be meeting in early November. So following that, we do have a rate increase then. It's sure as damn it will come through as a rate increase for everyone.
What happens if a homeowner can't afford to pay the big hike in their mortgage?
Well, the main thing is if you do have any problems in paying your mortgage, the first thing to know is that you should always correspond and communicate with your lender. It's so important to not just sit back and ignore the situation. So if you are in problems, banks these days will listen to you and will try and help you through the difficult periods until you get back on your feet again.
And who will this most impact? I'm thinking, is it a particular age group, demographic?
Well, the mortgage situation is going to affect everybody, really, because whether you're buying your first home or you're moving to a larger home or you're downsizing or you're releasing equity, you're still going to be faced with the same mortgage conditions and the higher interest rates that are being available.
And moving away from mortgages for a moment, Mark, and onto the general cost of living, because everything is going up, as we know. What if we don't have savings to top up these price rises? What can we do?
Well, one of the things that I always talk to clients about, whether they are wealthy or not wealthy, is having a budget. And it's so important to sit down and really think about where the money goes. And sometimes that's quite a sobering thought. When you go through, but if you can look to shave off here and there to help to raise more money or to free more money up for your family finances, that's a really good idea. The other thing people can do is simple things like before your car insurance comes up for renewal or your house insurance, if you pop that on your diary or on your calendar 2 or 3 months beforehand, then it gives you time to shop around, and you'd be surprised how much you can save on these on just shopping around at that particular point. There's a great website that the government sponsor, and that's the Money Advice Service, and that can give really good practical help and information about how people can manage during difficult times.
Are there any people that are actually going to benefit from the situation that we're in at the moment?
Well, I think it depends on how you look at it. So if you think about the property market, if this mortgage situation or the interest rate situation does lead to a reduction in property values, then of course the first-time buyer is going to benefit from lower prices. But if you look at the budget in particular, then you're looking at tax cuts which are going to help everyone. But at the highest level, of course, the highest earners in the country will be 5% better off. And then for basic rate taxpayers, they're going to be 1% better off. And the national insurance increase will be scrapped from next year. So
I've also been wondering, Mark, because obviously we've had quite low, limited growth over the last decade. Was something quite radical needed like this in order to try and move in a different direction? I wonder, from your experience, where you think that we needed something like this in order to try and increase growth.
Well, I've been practicing in the financial sector for 36 years. I know I don't sound old enough, but I have. And I've seen the movements and the vicissitudinal movements of cycles and mortgage rates and stock markets, and it goes up and down all the time. In my back in the 1990s, I remember when mortgage interest rates were 15%. So comparatively, they're still very, very low. But I think what's really brought this about is as I say, the COVID situation, the interruption COVID has made to the world, and then on top of that, the measures governments have had to take to address the financial problems. And then again, of course, with Putin, the interruption of food and utilities and the like has led to this. But you will always have bubbles bursting every so often for whatever reason.
Mark Chandler, good to speak to you. Thank you so much for being on the show. He's an independent financial expert at Ellis Bates.